In July 2011, one Australian dollar bought $1.10 of American money. A miner in the Pilbara, paid in Australian dollars, was richer in global terms than an American doing the same job in Texas. Australians flew to Los Angeles and shopped like kings. Economists in Canberra started using a word they'd never needed before: overvalued. 15 years later, that same Australian dollar buys around 65 to 67 US cents. The country didn't get poorer. Its mines didn't stop producing. Its banks didn't collapse. Its government didn't default. And yet the currency lost nearly 40% of its purchasing power against the dollar of a nation whose central bank Australia does not control, whose president Australians did not elect, and whose interest rate decisions are made in a boardroom in Washington, D.C., 10,000 kilometers away. This is the story of a currency that behaves nothing like the 10th largest economy that issues it. On paper, Australia is a rich, stable, AAA-rated democracy. In the foreign exchange markets, the Australian dollar trades like an emerging market gamble, a risk asset, a commodity proxy, a currency that professional traders buy when they're feeling brave and dump the instant they get scared. Why does one of the wealthiest nations on Earth carry a currency with the personality of a mining stock? The answer starts with a decision made on a Friday afternoon in December 1983, and it runs straight through Chinese steel mills, Wall Street trading desks, and a slow-motion global revolt against the dollar itself that is happening right now. To understand why the Australian dollar behaves the way it does, you have to understand what it used to be, a number set by bureaucrats, not markets. From the end of the Second World War until the early 1970s, the Australian pound, and later the Australian dollar, was pegged, first to the British pound, then to the US dollar under the Bretton Woods system. The exchange rate wasn't discovered by traders shouting bids across a floor. It was decided. A committee of Treasury officials and the Reserve Bank would meet, sometimes daily, and simply announce what the currency was worth that morning. This was a country that, for decades, rode on what economists called the sheep's back: wool, wheat, beef, and later coal and minerals, sold predominantly to Britain and Japan under a system that valued predictability over efficiency. When Bretton Woods collapsed in 1971 after President Nixon severed the dollar's link to gold, Australia didn't immediately float. Instead, it moved to a peg against a basket of currencies, then to a managed float in 1976, where the Reserve Bank still set the rate every morning, but adjusted it based on trade-weighted movements. By the early 1980s, this system was breaking. Global capital flows had exploded in size. Foreign exchange trading volumes worldwide were growing far faster than Australia's tiny domestic market could absorb. The Reserve Bank was spending enormous reserves trying to defend an exchange rate that speculators increasingly believed was wrong. In 1983, the incoming Hawke Labour government inherited an economy with inflation running above 10%, unemployment near 10%, and a currency peg that the market no longer believed in. Every time a rumor circulated that a devaluation was coming, billions of dollars would flee the country in hours, and the Reserve Bank's own governor at the time, Bob Johnston, was warning that defending the fixed rate was becoming close to impossible, without either abandoning open capital markets altogether or losing control of the currency to speculators. Australia in late 1983 was, in other words, a resource economy trying to run a 1950s exchange rate system in a 1980s world of instant, borderless capital. Something had to give. On the morning of Friday, December 9, 1983, Treasurer Paul Keating walked into the cabinet room at what is now Old Parliament House with a letter in his hand. He'd asked Reserve Bank Governor Bob Johnston to write it the night before. The letter warned that the volume of foreign exchange flowing through the bank's trading desk had become unmanageable, and that Australia faced a stark choice: either let the Reserve Bank step back from setting the exchange rate, or impose direct controls on capital moving in and out of the country. The Treasury Secretary at the time, John Stone, argued fiercely against floating. He wanted capital controls instead, walls around the economy, not open markets. But Keating brought Johnston, not Stone, to the press conference that afternoon, a deliberate signal about which side had won the argument inside government. Prime Minister Bob Hawke backed the float. So, notably, did the opposition's shadow treasurer at the time, John Howard, one of the few moments of bipartisan consensus on a decision this consequential. Keating told reporters that afternoon that under a float, speculators would now be speculating against themselves rather than against the government's reserves, because there would be no fixed target left to attack. One banker, reflecting on the news that night, admitted he was absolutely staggered and confessed he wasn't sure the government understood what it had just done. That skepticism was reasonable. This wasn't a technical tweak. It was Australia handing the value of its own currency to global markets, permanently, with no mechanism to take it back. The float officially took effect the following Monday, December 12, 1983. From that day forward, the Australian dollar's value would be discovered minute by minute by anonymous buyers and sellers in Sydney, London, New York, and eventually Tokyo and Shanghai, not decided in a Canberra meeting room. The stated intent was narrow: stop hemorrhaging foreign reserves, and let the exchange rate absorb economic shocks, instead of the government having to defend an arbitrary number. The float was bundled with a broader deregulation agenda, licensing foreign banks to operate in Australia for the first time, loosening restrictions on lending, cutting tariffs, and dismantling the centralized wage-fixing system that had governed Australian pay packets for most of the century. What nobody in that cabinet room in 1983 explicitly debated, because nobody could have predicted it, was what this currency would become over the next 4 decades. Not a stable reflection of a wealthy, diversified first-world economy, but a leveraged, real-time referendum on Chinese steel demand, American interest rate policy, and global risk appetite. Former Reserve Bank Governor Glenn Stevens would later call the float one of the most profound economic policy decisions in Australia's modern history. He wasn't exaggerating. Every currency crash, every mining boom windfall, and every present-day headache about import prices traces back to that Friday afternoon decision to let the market decide. For its first 2 decades, the floating Australian dollar behaved roughly the way textbooks predicted. It drifted in a wide band, mostly between 50 and 80 US cents through the 1990s, tracking Australia's terms of trade and interest rate differentials without much drama. Then China happened. Starting in the early 2000s, China's industrialization went into overdrive. Hundreds of millions of people moving from rural provinces into cities, requiring an almost unimaginable build-out of apartment towers, railways, ports, and factories. All of that construction needs one thing above almost everything else: steel. And steel needs iron ore. Australia, and specifically the Pilbara region of Western Australia, sits on some of the richest, easiest to mine iron ore deposits on the planet. Between 2003 and 2011, what economists now call the China commodity supercycle sent iron ore prices from around $20 a ton to spot prices exceeding $180 a ton at the peak. Australia's terms of trade, the ratio of what it earns for exports versus what it pays for imports, hit levels around 75% above the average of the preceding 100 years. This was not a normal boom. It was close to a lottery win, sustained for the better part of a decade. The Australian dollar rode this wave almost in lockstep. In October 2010, spurred by a surprise Reserve Bank rate hike to 4.75% amid fears of overheating, the Aussie touched parity with the US dollar for the first time since the float. By July 2011, it hit a post-float record of $1.10.8 US, a level no other major commodity currency in the world matched against the dollar in that window. Australians on overseas holidays discovered that everything in America suddenly felt free. Local manufacturers discovered that everything they tried to export suddenly felt impossibly expensive. But this is where the deeper mechanism of the Aussie dollar reveals itself. And it isn't only about iron ore. It's about interest rates and risk appetite. Through the 2000s, the Reserve Bank kept Australian interest rates meaningfully higher than the near-zero rates in the United States, Japan, and Europe. That interest rate gap turned the Australian dollar into one of the world's favorite carry trade currencies. Hedge funds and banks would borrow money for almost nothing in US dollars or Japanese yen, convert it into Australian dollars, and park it in Australian bonds or bank deposits to pocket the difference. This is leveraged, hot money. And hot money is fast to arrive and even faster to leave. The 2008 global financial crisis showed exactly how fast. In the second half of 2008, as Lehman Brothers collapsed and global risk appetite evaporated overnight, every carry trade on the planet unwound simultaneously. The Australian dollar, which had hit a post-float high near 98 US cents in July 2008, crashed to a low of just 60 US cents by late October, a decline of almost 40% in barely 3 months. On the single evening of October 8, 2008, the Aussie fell 9% against the US dollar in about 6 hours of trading. This was, at the time, the fastest depreciation the currency had experienced since the float 25 years earlier. The Reserve Bank responded with the most aggressive rate-cutting cycle in its history, slashing the cash rate from 7.25% in early 2008 down to 3% by April 2009, a 4.25 percentage point collapse in barely 7 months. Notice what actually moved the currency in that crash. It wasn't a change in how much iron ore Australia was digging up. It wasn't a downgrade of Australia's sovereign credit rating, which never happened. It was fear, thousands of kilometers away, in New York and London, causing global funds to flee anything considered risky. And the Australian dollar, despite backing one of the world's most stable governments, got filed under risky, right alongside emerging market currencies. Reserve Bank research from that period found the Aussie had an unusually high correlation with the US S&P 500 stock index during the crisis, because traders were using it as a real-time proxy for global risk sentiment, not as a measure of the Australian economy itself. The pattern repeated on the way back up. The commodity boom resumed after 2009 as China rolled out stimulus, pushing the Aussie back to parity by 2010 and its record high by 2011. Then, as China's breakneck growth began to slow after 2011 and the US Federal Reserve started signaling it would eventually raise rates from crisis-era lows, the carry trade reversed again. The Aussie fell from parity to under 70 US cents in a little over 2.5 years. From 2015 through 2019, the Fed raised rates while the Reserve Bank cut, widening the gap further and dragging the currency down further still. A mechanical, almost predictable relationship between what happens in a Washington boardroom and what an Australian pays at the supermarket checkout for imported goods. Fast forward to today, and the machine is still running exactly the same way, just with new inputs. In March 2020, as COVID panic triggered another global flight to safety, the Aussie crashed to 57.4 US cents, its lowest level since the depths of the GFC, before the Reserve Bank cut its cash rate to a record low of 0.1% and launched its first-ever bond buying program to hold the financial system together. Since then, the relationship between Washington and Canberra has only tightened its grip on the currency. As of mid-2026, the Reserve Bank's cash rate sits around 3.6%, while the US Federal Reserve, after a series of cuts through late 2025, has its benchmark rate around 3.75 to 4%, meaning, remarkably, that for the first time in years the gap has narrowed to almost nothing, and the Aussie has been trading in a range around 65 to 67 US cents. Every Federal Reserve statement is parsed by Australian traders within seconds. Every Chinese manufacturing data release moves the price of iron ore, which still accounts for a huge share of Australia's total export revenue, and which in turn moves the currency traders use as their favored proxy for China's economic health. Australia supplies roughly 60% of the iron ore that crosses the world's oceans, and China buys more than half of all seaborne iron ore on Earth. That single trade relationship, more than any domestic Australian policy, still explains a huge share of how the Aussie dollar moves in any given month. For everyday Australians, this system has very real, very unglamorous consequences. When the Aussie weakens against the US dollar, imported cars, electronics, fuel, and medical equipment all get more expensive, feeding directly into inflation even when nothing in the domestic economy has changed. When it strengthens, Australian exporters, miners, farmers, universities selling education to foreign students, take a hit to their competitiveness. Successive Reserve Bank governors have openly described the exchange rate as a shock absorber for the economy, and that's true. But a shock absorber, by design, is something that gets compressed hard so the rest of the vehicle doesn't have to be. Australian households are, in a very real sense, riding in that seat. And now a bigger structural shift is underway that could reshape this entire system for decades to come. The US dollar's dominance of global reserves, the trust that central banks worldwide place in holding dollars as their safety net, has been quietly eroding. The dollar's share of global foreign exchange reserves peaked around 72% in 2001. By the final quarter of 2025, according to International Monetary Fund data, it had fallen below 57% for the first time since 1995. In its place, central banks, particularly the expanded BRICS bloc of Brazil, Russia, India, China, South Africa, and now Egypt, Ethiopia, Iran, the UAE, and Indonesia, have been buying gold at a pace not seen in modern history, adding more than 800 tons in 2025 alone, pushing gold's share of official global reserves above 20%. For the first time since 1996, foreign central banks now collectively hold more gold than US Treasury debt in their reserves. This matters enormously for a country like Australia, sitting in the middle of this shift. A resource-exporting economy, tightly linked to China through trade, is watching two of its biggest anchors, the US dollar system and Chinese industrial demand, both undergo historic realignment at the same time. If global trade genuinely fragments into competing currency blocks, a mid-sized commodity exporter like Australia, whose entire financial architecture from mortgages to superannuation to trade settlement is built around US dollar pricing, faces a structural question it has never really had to answer since 1983. What happens to a currency built to track a commodity supercycle and a dollar-centric world, when both of those anchors start to move independently of each other? Strip away the jargon, and the story of the Australian dollar is a story about what happens when a country chooses openness over control. The 1983 float gave Australia enormous benefits. It absorbed shocks that would otherwise have caused deep recessions. It forced the economy to modernize, and it underwrote more than 2 decades of uninterrupted growth that followed. But that openness came with a permanent trade-off. Australia gave up the ability to insulate itself from decisions made in Beijing steel ministries and Washington boardrooms, in exchange for a currency the whole world was free to buy and sell on a whim. 4 decades on, the Aussie dollar remains what it has been since the moment it started trading freely. Not a pure reflection of Australia's own economy, but a live, minute-by-minute referendum on how the rest of the world feels about risk, about China, and about the US dollar itself. Whether the next chapter is written by a genuine global move away from dollar dominance, a new commodity boom, or the next financial crisis nobody has forecast yet, one thing about this currency has held true since December 1983. Australians don't fully control the value of their own money. The market does. And the market, more often than not, is looking somewhere else entirely. At a boardroom in Washington, or a steel mill in Hubei province, when it decides what an Australian dollar is actually worth.